One of the biggest retailers, if not the biggest retailer in the world, Amazon, is loved by many due to their assortment of goods and convenience when it comes to shipping. Looking at the profile, Amazon.com Incorporated engages in the retail sales of consumer products and subscriptions in North America and international. The company operates through three segments: North America, International, and Amazon Web Services, AWS. It sells merchandise and content purchased for resale from third-party sellers through physical and online stores. The company also manufactures and sells electronic devices including Kindle Fire, Fire tablets, Fire TVs, Rings, and Echo and other devices. Provides Kindle Direct Publishing, an online service that allows independent authors and publishers to make their books available in the Kindle store, and develops and produces media content. At a whopping price of $3,247, is this juggernaut of a company worth this value? Howdy everybody, and welcome to another stock analysis video. And well, we are going to do a very quick analysis on Amazon and see if, based on their fundamentals, is $3,000 worth what this company is offering. We shall find out. Coming over here to the calculator, we input the ticker symbol and we see that Amazon has a current PE of a whopping 56.59. We would like this to be less than 20. So right off the bat, this is looking very, very expensive. Market cap of $1.6 trillion, does not pay a dividend, so all of that cash flow is just going to go straight into paying off their debt and making acquisitions. Now, coming over here to the fundamentals, I am going to make an assumption that Amazon will keep growing within the next 5 years at a 35% growth rate. My reasoning for this is that, well, here on Seeking Alpha, we see that the year-over-year revenue has actually increased by 37.76. So me assuming 35 is fairly reasonable, a little bit more conservative, not too much, but I believe that Amazon has a very, very bright future. Next, looking at the net income, we want this to be increasing, and as you can see, it went from $2 billion to $21 billion in 2020. Now, something to note: 2 billion, 3 billion, 10 billion, 11 billion, 21. So you can see this massive jump from 2019 to 2020, and I believe the 2020 revenue numbers is mainly due to the fact that everybody was locked down due to COVID and people were just doing a lot of online shopping. So definitely an outlier to look at. Next, looking at the free cash flow, we want this to be increasing, which is so from 9.4 billion to almost 26 billion. The average free cash flow over the past 5 years is a massive $16 billion. Wow. Next, we got the total revenue. Of course, we want this to be increasing as well, and it is by a lot. 2016, almost $136 billion, and in 2020, $386 billion, which is an increase of almost 65% over the past 5 years. Next, we got total debt. Of course, we would like this to be decreasing. However, by the looks of it, it is not 20 billion to 123 billion. But then again, with everything else that they're doing, this debt kind of justifiable. Next, shares outstanding. We would like this to be decreasing because this tells us if they are diluting the investor or they're giving them a bigger piece of the pie. And by the looks of it, they are issuing shares, which is definitely something to note. Now, they're issuing shares at almost at a 6% rate over the past 5 years. So it's not necessarily that much of an increase, but it's still an increase nonetheless. And lastly, the cash and equivalents, we see that as of this year, they have $40 billion in cash and equivalents, with an average cash and equivalents over the past 5 years of almost $32 billion. And now with all of those metrics, we see that the target share price for Amazon, not adjusting for debt, is $2,781.10. After adjusting for debt, we see that it actually drops down, mainly because they have a ton of debt, to $2,620.77. With a margin of safety of 5, 10, and 50%, the ideal price to buy this at would be at around $2,000 $2,358, and $2,227 respectively. Now, at this current price, most people would say it needs to drop $600+. That will never happen. It just won't happen. And that's only for the target share price after debt. With the margins of safety, it needs to go down even further by like $1,000, which is absolutely insane. That will never happen. Well, that's not necessarily true. Stocks do fall and stocks do rise. Eventually, they will meet at the point where the price of the stock will match the fundamentals. And this is just an example. Amazon in April of 1999 was worth $86. And after the crash of 2000, it bottomed out at September 4th, 2001 at $6. So this idea that Amazon will never fall to 2,227 is not necessarily a true statement, because stocks eventually do follow their fundamentals. The stock market in the short term is a voting machine, and in the long term it is a weighing machine. Eventually the ticker price will match the fundamentals, and when that happens, I will be willing to buy Amazon now that the ticker price is based on their fundamentals. That pretty much does it for this episode, everybody. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You can also follow me on my new tech sites of BitChute, Odyssey, and Rumble, where you will get these videos, my weekly crypto videos, and also exclusive videos when it comes to stocks, which I'm planning to do, and exclusives when it comes to crypto as well. And when it comes to Rumble, I have a Let's Play channel, also link in the description. So if you would like to watch something that's not investing related, make sure to follow that as well. Alright, so with that said, peace out, and I'll see you all in the next stock analysis video.